Welcome to Looking at the Markets with David Modell. Today we're going to be talking about a few different things. What moving averages should I use? Plus thoughts on RSI and Bollinger Bands. As a swing trader, I like to buy dips within an overall uptrend. I use overbought, oversold indicators such as Bollinger Bands and RSI to help me decide if there is a dip or temporary oversold condition. Meanwhile, I use the 50-day and 200-day moving averages to help me determine if there is an overall uptrend. I tend to use the simple moving average, or SMA, rather than the exponential moving average, or EMA. The simple moving average is just an average. For example, the 50-day SMA is the average price of the last 50 trading days. On the other hand, the exponential moving average is a weighted average that gives more weight to recent trading days. For example, the 50-day EMA will give recent prices more weight or importance than prices from 40 or 50 days ago. As a result, the EMA tends to react more quickly to price movements. Traders who want a more reactive moving average with less lag might choose the EMA. For this reason, the EMA may appeal to day traders and other short-term traders. However, some traders would say that the SMA gives more of a true average for the overall time period. The SMA also tends to be smoother and steadier and gives fewer trade signals. Thus, the SMA may appeal to some swing traders as well as long-term investors. So in the end, the choice of SMA or EMA is really a matter of personal preference. So here's an example of a 50-day simple moving average, and that's the blue line on the chart, versus the exponential moving average, which is the red line on the chart. And they're both 50-day, as you can see. Simple moving average, exponential moving average. And you can see on the chart how the EMA is more reactive to price jumps. So for example, the price jumps here, and the simple moving average doesn't really react much to it, whereas the exponential moving average reacts to it much more. Also over here, see more of a reaction from the EMA, and over here as well. The price jumps, the SMA doesn't react much, if at all, while the EMA reacts. Whether you choose to use the SMA or the EMA, you'll want to select time periods that fit your time frame and trading style. I recommend experimenting with different moving average time periods on your charting site, app, or software. As a swing trader, I use the 50-day and 200-day simple moving averages to determine whether the overall trend is up, down, or sideways. This is how I check the overall health of the patient, so to speak. I want to buy dips within an overall uptrend, and the long-term moving averages help me to make sure that the overall trend is up. In other words, they help me to make sure that the patient is healthy. Meanwhile, I use overbought, oversold indicators, such as Bollinger Bands and RSI, to look for buyable dips within an overall uptrend. It's like if a patient catches a cold, that's the dip, but is still generally healthy, that's the overall uptrend. You can be fairly confident that the patient will recover soon. Thus, I use long-term moving averages to make sure that the general trend is up, and I use overbought, oversold indicators to look for temporary dips so I can buy the stock with confidence. So this XLU chart provides a perfect example. Both moving averages are trending upward. You can see in blue, the simple moving average, and the blue is the 50-day simple moving average, and the red line is the 200-day moving average, and they're both trending upward. And the 50-day simple moving average is above the 200-day moving average, simple moving average. So the patient is healthy, meaning that the overall trend is up and it looks good. Sometimes this patient caught a cold, but recovered quickly. So like it dipped over here, but came right back up, dipped here, came right back up, dipped here, came right back up. So if you had bought XLU stock, actually it's an ETF, every time it touched the lower Bollinger Band, you would have profited within a few days. Okay, touched it over here, and then you would have made a nice profit if you had bought it here and then held on. Touched it here, you would have profited if you bought it here and held on. It touched it here, went down but came right back up, would have made a nice profit there. Touched it, and then it touched it here and bounced right off of it. And if you'd held on for a while, would have made a nice profit there. For day traders, as well as traders who hold for a few days, shorter term moving averages might be more appropriate to determine the trend. Examples would include the 5-day, the 8-day, and the 10-day exponential moving average or simple moving average. It's not a bad idea to choose two moving averages. For example, I use as you saw, the 50 and the 200. Because having too many moving averages on your charts can lead to confusion. So I recommend having only a couple or very few moving averages to look at any one time. So even the healthiest patients will catch a cold from time to time. As a trader, you can take advantage of this through the use of moving averages. And if you need more help with this or any other aspect of trading or investing, please feel free to contact me anytime. You can reach me through my email at davidmodell@gmail.com. I hope this was helpful, and I'll talk to you real soon.